Chapter 5, Problem 6. This problem's a little long, but again, as is time and time again, we've seen it's mostly the accounting babble that we have to get through. I need to draw your attention to a couple things. The ending inventory consisted of 30 units. Altogether, if you add those together, we had 400 units total. So the total goods available was 400 units. So we sold 370. So we have 30 left. Okay? What that means is that we either sold all of these and some of these, or all of these and some of these, whether we choose LIFO or FIFO. So, the operating expenses were $4,100. That will not change no matter which method of inventory we use. And we sold the units at $90 each. That will not change. So they want us to compare the gross margin using FIFO, LIFO, and weighted average. Now I want you to know, I'm a big believer in little mnemonic devices. LIFO will yield the lowest income. LIFO, lowest. Okay? So when we're all done, if our LIFO income is not less, we have to go back and do it again. So let's take a look. Here's the first part. Remember, we sold 370 units and they were $90 each. That's not going to change. So if you do that multiplication, that works out to 33,300. And that won't change, doesn't matter what method we use. Cost of goods sold. LIFO, this is FIFO, I'm sorry, FIFO. And that's another thing, make sure you know what you're doing, because it's easy to get it backwards. FIFO, first in, first out. So we're selling the oldest ones first. So we've sold all of the beginning ones. So we sold all 90 of those. So that's 90 units at $40 each. And we sold a total of 370 units. So if we sold 370 and we know 90 of them were at $40 each, we have to do our subtraction of 280 to find out how many from the newer purchase, the $45 units, we sold, and we sold 280 of those. So let's do our multiplication. 90 times 40 is 3,600. 280 times 45 is 12,600. And no, please don't think I'm a genius. I'm reading from the notes I worked up a few minutes ago. So the total cost of goods sold, $16,200. And remember, our definition of gross margin is sales minus cost of goods sold, and our gross margin is 17,100 under FIFO. Now they say, okay, do it again, this time using LIFO. So we're going to do it using LIFO. And I want to make sure that we see that. LIFO, last in, first out, means the first in are still there. So under LIFO, we still sold the same 370 units, okay? And we still had the same amount. So we sold 370 units. We sold as many as we could from the new units, from the ones that just came in, because LIFO, last in, first out. Last in means the ones that came in most recently. The oldest ones are still there. So we sold all 310 of those. So we had 310 at $45. And of the 370, we accounted for 310. So we need the price of 60 additional units. And we'll take those from the oldest units. LIFO, last in, first out. First in, still there, as much as possible. Here we sold units, so we had to sell some of these, because we sold all of these, and then we sold 60 of those at $40. So 310 units times $45, $13,950. 60 units at $40, $2,400. Our total cost of goods sold, $16,350, and our gross margin is sales minus cost of goods sold, $16,950. Then the last piece it asks us, it says, well, what about weighted average? Weighted average, you make pretend all the goods cost exactly the same amount. So what we're going to do is we're going to take the inventory that they gave us in the very beginning. We had 400 units, so we're going to have to do this. We're going to have to do 90 times 40 plus 310 times 45. Okay, so that gives us 3,600 plus, what's that work out to? We did that 13,950. We add those together, that gives us 17,550. So the total that we paid for all of those was $17,550. And altogether we had 400 units. We paid $17,550. We had 400 units. That works out to, if you do that math, $43.87.5 per unit. Okay? If you want to round it up to 88, go for it. So, under the weighted average, we make pretend all the units cost us exactly the same thing. The units we sold, the units we kept, cost us the same thing. So, our cost of goods sold was 370 units times $43.87.5. And when you multiply that out, you come out to $16,234. And I rounded to the next highest whole dollar because you wouldn't round down because you had to sell a whole unit. $16,234. So our gross margin under weighted average is $17,066. So now we've done the gross margin under all three methods. Now it says compare these, learn something. So let's compare them and let's learn something. And this is the important part, because this is the part that you as a manager will be asked to consider. Taking a look at weighted average, our weighted average cost of goods sold is $16,234. We got that from there. Our gross margin, $17,066. Now, we're told that our operating expenses across the board are $4,100. They will not change based on our inventory method. Notice that our sales will not change based on our choice of inventory method. So these items will not change. The items that will change are the cost of goods sold and the gross margins. And that would be significant. Now these are relatively small numbers, but you can multiply this by as many millions as you want to get an idea about how big this could be. This is LIFO. Our cost of goods sold is $16,350, and our gross margin is $16,950. So cost of goods sold, $16,350. Our gross margin, $16,950. And the last one we have to look at is FIFO. Our cost of goods sold is $16,200, and our gross margin, $17,100. So, cost of goods sold, $16,200, and all of these are subtractions. Remember, the definition of gross margin is sales minus cost of goods sold, $17,100. Now here's where it gets interesting. Remember, operating expenses subtracted from gross margin gives net income. Under FIFO, our net income is $13,000. Under LIFO, our net income is $12,850. And under weighted average, it's $12,966. And if you look at that, it makes sense. The average comes right in between the two. LIFO will give the lowest income. And that will save a company taxes. Suppose there was a bunch of zeros behind that. 40% of a bunch of zeros is a lot of money. That's why companies, if they can and if it's worth it to them, will choose LIFO. Only the very largest companies do LIFO because it is fairly time consuming with regard to accounting. Okay, the last part I'm sure is the part that you've been looking forward to. Determine the cash flow from operating activities using each of the three cost flow assumptions. I want to focus your attention on cash flow. Okay? So our cash flow from operations from FIFO was $33,300. Our cash flow from customers under LIFO was $33,300. And our cash flow under weighted average was $33,300. Now let's take a look at our cash outflow for inventory and expense. They bought $17,550 and they had $4,100 in sales. So let's add that up. $17,550 and $4,100 for customers. Zero, 5, 6, 21,650. But that's saying that all of this went out in cash and that all of this went out in cash. The cash outflow for inventory really was what we actually spent, what actually went out, and that was, and if you think about it, what we actually spent, what we actually sent out was the FIFO amount, because that's the way it works. You sell the oldest ones first, so they went out and then the other ones went out, okay? And they tell us what the operating expenses were. They tell us all purchases and sales were made with cash. So they had the beginning units and they purchased these, so they purchased 310 units at $45, and we did that number somewhere, I forget where. I'm looking through my notes here to come up with that number. That's $13,950. And we spent $41 for salaries. So that's what we spent. The trick was you had to remember that this was what they had at the beginning. This is what they bought this year. They tell us the beginning inventory means it was there at the beginning of the year. This is what they purchased. So they spent $18.50. And that $18.50 is the same under FIFO, LIFO, and weighted average. So the net cash flow from operating activities is 15,250, irrespective of the method chosen. The thing you can mess up is if you take all of the inventory and not just the inventory that was purchased. This was what was purchased this year. That includes what was purchased this year and the 90 units we had at the beginning. A little bit of a long problem, but it ties it all together. And the important thing is that and that. Companies want to, if they can, use LIFO, but by far most companies use weighted average because it's simpler.